Well, hello, everybody. Welcome to this quarter's Market Outlook and Strategy webinar titled Opportunity in International Stocks. My name is Jeff Porter. I'm a principal here and Chief Investment Officer. And as always, I'm joined by the gang, Gary Lyons, Senior Director of Portfolio Management.
Hello, everyone.
And Ken Alozie, Director in the Portfolio Management Department.
Hello, everyone.
So here you see our agenda for today's presentation. We're going to start off by reviewing the asset class returns through the first half of the year, giving a few comments there. But the remainder of the presentation is just going to be talking international stocks. So, over the past couple years when we've been mentioning international stocks, it's been in the context of their appealing valuations. And for you newcomers, valuations are just how cheap or inexpensive an investment is. And as a reminder, we talk about it so often because studies show that over the long term, the best predictors of returns are, in fact, valuations. But today we want to dive a little bit deeper. We're going to start off by giving you an overview, kind of a general education of the international markets, and then turn our attention to the case, the positive case for international stocks. Not only having them in your portfolio, but increasing the amount of money that you're putting towards international stocks like we've done really over the past year and a half or so. And then we'll wrap up by talking about some portfolio positioning. So let's take a look at these asset class returns. And as you can see, there's a lot of green arrows there. So regardless if you're a conservative investor with a lot of bonds in your portfolio or an aggressive investor with a lot of stocks, you should feel you're really pleased with the first half of the year. So if you look left there, you see that U.S. short-term bonds chipping away at profits there at up 0.7%. Then you got the U.S. aggregate bond index. So what this is just the taxable bond universe, but that's doing nicely at 2.3% growth. And then tax-free municipals doing a great job, 3.6%. So this is kind of a flip-flop from last year where municipals underperformed the taxable bonds. But in general, we still like bonds to give you that safe income throughout the year or out the years. But most importantly, it offers that ballast in the portfolio, the flexibility in your portfolio when stocks go down. But certainly, as you can see, not an issue of stocks going down thus far this year. U.S. large cap stocks up a nice 9.3%. U.S. small company stocks up 5%. So these gains are really on the back of strong corporate earnings growth in the first quarter and most likely again in the second quarter. They're coming out right about now. But it's also due to the fact, what we talked about last webinar, which was the synchronized growth that's going on around the world. So not only is the United States in an economic expansion, but so too is Europe, so too is Japan, and a number of the emerging markets. So when you got everybody moving in the right direction, that really helps the U.S. stay out of a recession. And as we've said, multiple times in the past, when the economy is not in a recession, the path of least resistance for stocks remains up. So, a quick note looking forward, the indicators that are the most respected out there are still saying that there's a low risk of recession in the next 6 or 12 months. However, there are some cracks that are starting to appear. So due to those cracks and the fact that we think the United States stock market is quite expensive, this prompted us to reduce our targets in our models to U.S. stocks. We increased our allocation to international stocks, and we're really taking a hard look at those clients where their U.S. stocks have drifted far above our target levels. So we're being proactive. We're going to be taking profits there and making sure those proceeds go to the international market or even bonds if bonds are underweight in their portfolios. So with that said, moving to the right there, international developed stocks having a great year at 13.7%. And the leader in the clubhouse thus far, emerging market stocks, up 14.8%. So Gary, let's continue talking about internationals, and let's start, as I mentioned, with a general overview. So I guess when you're first starting out constructing a portfolio, you got to think global, right?
Definitely, Jeff. The U.S. contains only about half of the world's investable opportunities, and international stocks make up a huge portion of the world markets. And especially as you see there, and I'm looking at the chart on the right, global gross domestic product, or GDP, or, just economic production versus the U.S. Now, it always feels safer investing in one's own country and currency, but when stocks are getting fully valued, like in the U.S., there are often better opportunities elsewhere in the world, as we've been talking to all of you about in our client meetings. There are also more potential gains to be made due to lower valuations in the international stocks, better earnings, and better dividend trends in the international markets, as we'll talk about later. And the reason it's so important to think globally is that, for example, as you see there on the chart, emerging markets have gone from 6% of global GDP in 1991, as you see there in green, to 41% currently. And Jeff, they'll only keep expanding.
Yeah, so when you're saying terms like emerging markets or international developed, what areas of the world, what countries are we talking about there?
Sure, and that's why we have this chart here. As you see there, international developed markets are in green. They account for about 10% of global population, and emerging markets are there in blue. That's about 80% of global population. Now, the internal consumption evolution of China and India has confirmed that these locations, Jeff, should be a dominant focal point for future thinking investors. And in fact, India and China account for 41% of the world's population. And the way economies generally evolve ensures that their internal consumption will have a significant impact on their market's growth and the stocks that are there in those markets. And we've seen large-scale reforms in these countries already, such as India's unified goods and services tax. That's the GST there, which turns India actually into a unified market for the first time. And Jeff, as far as growth is concerned, both China and India will continue to grow at rates, as you know, that are multiples of the U.S. And I like to think of this as a similar situation as when the U.S. replaced the U.K. in the early 20th century. And we became, actually, in the U.S., the dominant engine of growth and profits in the 20th century.
Yep, lucky for us. So Gary, you mentioned population, though, and just because one country or another has a bigger population doesn't necessarily mean that you're investing more of your money there, automatically. So let's get a little bit more detailed. If a client is in an index, for example, in the developed international stock area or an index in the emerging markets, what percentage exposure is going to which countries, and what kind of stocks companies are they buying or investing in?
Definitely, Jeff. Let's look at that. So as you see here on this slide, international developed market countries are there on the right. You see both the countries and the weights. We show you this to help you understand that these investments are real. Make them more realistic to you. On the left, at the bottom there, you see Nestle, Novartis, Samsung, HSBC. And you see the same for the emerging market countries there on the right, both the countries and the weights. At the bottom, names you may know, like Taiwan Semiconductor. They're the world's largest semiconductor foundry. Apple, Qualcomm, Advanced Micro Devices. Really, the top 127 brands of electronics in the world use their chips and controllers. They're literally in everything. You see there Tencent Holdings, which is the Asian Amazon, like Baidu, which is the Chinese Google. Also companies like China Mobile, which is listed on the New York Stock Exchange. And it's actually the largest mobile telecom company in the world. It's incredible, 1.17 billion subscribers. So, Jeff, investing in these companies and in these countries gives us exposure to these explosive growth opportunities. And when you've got a large population like you see in these countries, you eventually start consuming, and companies arise to meet that need, oftentimes inside those companies. So they're countries, so they're on their stock exchanges.
Yeah, so you got that natural demand, and it's always important to remind people that U.S. doesn't have a monopoly in high-quality, well-run companies. They also don't have a monopoly on very entrepreneurial, very high-growth companies. Certainly, Tencent is an unbelievable example of that with their growth rate. So thanks, Gary. Now that we've gotten a little background, a little overview on the international markets in general, let's start now making the case for that. And anytime you're adding something to a portfolio or expanding something in the portfolio, you got to look for its impact on diversification. So Ken, why don't you come in here and start talking about that?
Absolutely, Jeff, and that's a great point. Why diversify abroad at all? Because after all, isn't the United States the best market to invest in? And this chart would tell you that that is not the case. And so what this shows you is annual returns by country, with the top performing countries of the year towards the top and the bottom performing countries towards the bottom. And these are just developed countries, so it doesn't even include emerging markets. And what you see here is that a lot of the times the United States is actually towards the bottom there, which is very, very interesting. So as Gary said earlier, United States definitely is not the only game in town as an investor.
Yeah, you see there in the late 90s there, U.S. is kind of in the upper half, so doing quite well. But then from 2002 to 2009 or so, it's definitely falling in the bottom half pretty much every single year. But recently it's kind of risen back up, has some great performance there. So Ken, can you narrow in on the past 4 or 5 years or so, discuss what went on there, what's going on right now, and then we'll talk about what may occur in the future.
Sure, and now is actually a great time to discuss that, because it feels like we could be at an inflection point. If you look at this chart here, the left side of the chart shows the annualized returns by region for the last 5 years, with the U.S. in blue, international developed in red, and emerging market equities in green. And what you see there is that the U.S. markets have outperformed both developed international and emerging market equities for the last 5 years. However, look on the other side of that chart. Although we're still getting robust returns in the United States, it's pretty evident by the chart that we're getting much better returns overseas, in both international developed markets and emerging markets.
And it becomes extremely useful when you expand this chart and look back in history, because you see then that these things run in cycles, don't they?
They do. And this chart actually illustrates that really well. If you look at the time period here with the charts in green denoting time periods where international markets outperform the U.S., the purple charts here show periods of time when the U.S. actually outperformed and international underperformed the U.S. And so as you can see, for the last few years or so, the U.S. markets have just outperformed international. But if you look to the very, very right of the chart, you'll see a little bit of speck of green there. And that's really because international markets, for the first time in years, are starting to outperform the U.S. So could this trend continue? Possibly. So there are definitely a lot of very sound arguments in favor of international outperformance for the next few years or so.
Yeah, and that's the question. Looking back 5 or 10 years from now, are we going to see a good amount of green, or a big spike up in green, or we're going to see more purple? And we think you're going to see a good amount of green. And these would be the reasons why right here. First of all, kind of going back to Old Faithful, the international markets are trading at attractive relative valuations to the United States and attractive valuations to their own history. So that's certainly important. The second point there, The corporate earnings overseas are really picking up, and now they're growing at close to double the rate of United States companies. And equally as important, or perhaps even more important, is that growth in earnings has a longer runway, we think, internationally than in the United States. Because likely international countries are earlier on in their business cycle expansion versus the United States, which looks like it's quite long in the tooth in their business cycle. The third point there, central banks, so important. The international central banks are continuing to loosen their policy, remain very easy, trying to stimulate their economies. That's different than the Federal Reserve. The Fed is in the midst of tightening policy, trying to increase rates, drawing back on quantitative easing, etc. So that divergence in policy is really in favor of international stocks. Lastly, if you look back in history, currencies tend to move in cycles similar to what we just saw in stock market performance. So if history is a guide, we could be nearing the end of a multi-year rally in the dollar. And that's important because when you invest your money overseas in an international stock, you're also investing in that currency. So if that currency appreciates during your holding period versus the dollar, that's going to be an added source of return. So that's important. So Gary, let's making a point on each of these, dig a little bit deeper, and let's start with valuations. I know the past couple webinars, past couple years, we've been really focusing in on the price of a market relative to the earnings. But you're going to show us another valuation metric, the price of a market divided by the book value, right?
That's right, Jeff. So historically on price, international stocks have traded at a 16% discount to U.S. stocks. Now that's the purple line that you see there. Currently on price, international stocks are trading at a huge 46% discount to U.S. stocks. That's the green line. But if we look a little deeper and measure international stocks market price, or what you pay, to book value, which is a company's asset value, they look at this point relative to the U.S. At a huge discount also, approximately a 47% discount to U.S. stocks for emerging market stocks. Now that's the lowest on those two metrics combined, weighted and combined, since 1991, and lower than the second best time in history for buying emerging market stocks. And as you know, if you've listened to these webinars before, the lower the starting valuations, the better the forward returns. So Jeff, this is confirmation of better opportunities in international markets.
Yeah, and to kind of drive home that point, okay, you see a big discount. That green line is very low, showing relative attractiveness from a valuation standpoint in international stocks. So look back and keep on going to the left and see the last time that this line was this low. And you see it's the late 90s there, about the beginning of 1999. So if we look at the beginning of 1999, over the following 7 years to the end of 2006, the United States stock market, the large cap stock market, the S&P 500, returned a total 31%. But the international developed markets nearly doubled that at 60%, and the emerging market stocks returned 298%. So do we think this is going to happen again? Well, we're not quite sure. But we know what valuations have told us in the past, and they tend to favor certainly internationals at this point in time. So Ken, why don't you talk next about earnings growth, obviously very important to stock market prices.
Sure thing. And this is a really, really important point because it's vital to remember that when we're talking about indexes and markets, that we're really just, at the end of the day, just talking about companies that are selling goods and services that hopefully have strong margins that result in positive and growing earnings over time. And if you look at this chart, you'll see that earnings growth is actually very robust, not only here in the U.S., but overseas. So if you look at the left side of the chart, for 2016, AGE stands for actual, that we did see some earnings growth. year over year as of the end of 2016. But take a look at the next, to the right of that, 2017, as of the end of the first quarter, actual year over year, we just saw robust earnings growth, not only here in the U.S., but we actually saw greater earnings growth in both developed international markets and emerging markets. And then if you continue to the right of this chart, you'll see that expected earnings, the E just stands for expected there for 2017 and 2018, is expected to be strong going forward as well. And so that's reflected in today's performance, and we're seeing that outperformance in part as a result of these earnings, the actual earnings and the expected earnings.
Yeah, and it's important to note that predicting earnings a year out, a couple years out, are it's a notoriously difficult task, especially at turning points for the economy. But that's why it's also important to get a sense of where we are in the business cycle. And as I mentioned before, we think the international markets, many of those countries around the world, are much earlier on in their business cycle than the United States. And what that simply means is that these earnings have more room to grow before the kind of the natural restraints of a business cycle kick in and start hurting earnings. So let's turn to the third point that we mentioned, which is central banks. So Gary, if investors have learned anything over the past 7 years, it's how outrageously powerful central banks are at some would say manipulating markets.
Absolutely, Jeff. I mean, you never want to fight the money printing force of central banks. That is deadly to your portfolio. So here we see total assets of the major central banks denominated in trillions. And, you know, as we know, while the Federal Reserve, or the U.S. Central Bank, there in red, is moving to reduce its monetary stimulus, the European, in blue, and Japanese, there in green, central banks are still expanding their monetary stimulus programs. In fact, the Bank of Japan and the European Central Bank's balance sheets, as you can see there, now exceed the Fed's for the first time ever. And as we've discussed so many times before, the Fed's quantitative easing programs, or money printing, were a boon to U.S. stocks, and thus we think should be a tailwind to international stocks, much like in the U.S. And the reason money printing is a short-term boon to markets is because the money, or the liquidity, generally goes first into the markets, and that does, as you said, Jeff, it lifts asset prices.
Yeah, I mean, Ken was talking about the past 5 years, and the performance differential there. We'll take a look at that red line starting in early 2013. I mean, just a moonshot up. The Federal Reserve was buying assets and pumping in liquidity hand over fist, but not so in the European Central Bank especially. That was going down. And then in 2014-15 or so, now we're starting to play catch-up overseas, and they've broken up even and now are continuing higher. So great chart here. So lastly, let's talk about the currency, that we mentioned before. So Ken, what's going on in the currencies? What can we expect there going forward?
Sure, Jeff. And currencies are a very, very important part of the equation because the movement of currencies definitely impact your equity returns as a U.S. investor. And like a lot of other assets, currency movements, at least when we are talking about the U.S. dollar, tends to move in cycles. So if you look at the chart here, we see that there are periods of time where the U.S. dollar is strong, where we see that activity above the line there. And then we have periods where the U.S. dollar is weak, which is the activity below the line. And so what this tells us is that historically, whenever we see a trend of a strong dollar, it's typically followed by a period of weakness. So if you look to the very right of the chart there, we see that the U.S. dollar has been strong for a while, which have hurt international equity returns, at least from the standpoint of a U.S. investor. And we believe that at this point, there is probably more potential for the U.S. dollar to weaken or rather than strengthen from these levels.
Yeah, Gary, you always say reversion to the mean is the iron law of investing.
Absolutely, Jeff.
And so, currencies, just like stocks and just like bonds and any other investments, after good times, they become expensive. And that's why bad times tend to follow good times, and things just move in these cycles. So this would be another tailwind for international stocks if the dollar starts trending down. So what we've laid out here is a number of factors that are aligning in the favor of international stocks, and that's why we're confident in them. Now, we're not Pollyanna. We don't think that they won't be harmed in case United States goes into a recession. There's a little saying in our world that correlations go to 1 when markets go down, meaning that you could be a small company, a large company stock, a value, a growth, an international or U.S. Most things are going down when the whole ship starts retreating. But if we can stay out of recession, we think the coming years will be very profitable to be an international investor. Or if we have a recession, if you look through that time period and look over the next 7 to 10 years or so, because valuations are so much in international's favor, we think they'll be profitable over that time period as well. So now that we've talked about kind of the case, now let's talk about some portfolio positioning within our client portfolios. So when we look at the internationals versus the United States, and you look at studies there, they show that really between 25 to 35% of your equity exposure being in internationals really maximizes the diversification. It gives you a lot of bang for your buck. It smooths out the ride, so to speak. So right now, we've been pushing that all the way up to about a 2/3, 1/3 split between U.S. and international stocks. And we're also letting our clients drift higher than that 1/3 allocation to internationals because we think it's a longer-term theme. So that's where we stand right now for most client portfolios. When you think about international developed stocks versus emerging market stocks, know that we prefer investing in emerging markets. So we're much more overweight there versus the developed world. We know it's very risky, but on the other hand, we think it's the asset class that's going to offer the highest long-term returns over the next 7 to 10 years or so. Europe versus Asia. So far, we've been overweight Asia for the past couple years, more so to just avoid some of the issues that are going on in Europe. The economy was not doing too well, but there was also a lot of political risk in the Eurozone. But that's really started to change, and it looks like they are on a path to get some reforms done in the coming couple years or so. So the risks are really diminishing in Europe, and they're becoming a much more attractive investment opportunity. So that does it for kind of the meat of our presentation. Instead of a number of different key takeaway points, we wanted to leave you with this quote. And it said, "The good markets turn to bad markets. Bad markets turn to good markets." So the system is almost rigged against human psychology that says if something has done well in the past, it will do well in the future. That is not true. That is categorically false. The last shall be the first, and the first shall be the last. So hopefully in this presentation, we gave you a good sense of why this may be the case for international stocks. So we appreciate you listening.
Thank you all so very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Ken, call your relationship manager if you need to discuss anything, or if you just want to comment, or if you have a question. We always enjoy hearing from you. Thank you.
Thank you.
Thank you for listening.